Understanding daily bias is one of the most important skills a trader can develop. It is often described as one of the most complicated ICT concepts, but in reality, it is very, very simple once you know what to look for. All you need to do is clearly understand these two concepts, and once you do, everything starts to make sense. The first one is the concept of candle science, and the second one is the concept of internal range liquidity through external range liquidity. So now let's break them down and go through them one by one. When I talk about candle science, these are the 4 candles I am referring to. Now let me explain each of them step by step. Let's assume that this is a daily chart. Here we can see that the first candle is bullish. Then the second candle pushes higher and closes above the high of the first candle. This tells us that we should be anticipating bullishness on the third day, at least expecting price to take out the previous daily high. Now, this also means that if price continues to close above the highs of the previous candles, then we should continue to maintain a bullish bias. But if price pushes up and suddenly is not able to close above the high of the previous candle, that now tells us something has changed. In that situation, we should start looking for sell opportunities, at least until price reaches the previous daily low. Now, the same logic applies in a bearish scenario as well. When price closes below the previous daily candle, we should be anticipating sell-side movement. But when price attempts to close below that level and instead ends up closing back above it, then we should start anticipating bullishness. So here, these are the 2 bullish scenarios where we should begin expecting higher prices. And these are the 2 bearish scenarios where we should start anticipating lower prices. Since we now understand candle science, the second way to simplify and understand daily bias is by using the concept of internal range liquidity to external range liquidity. This is honestly the concept that completely changed the way I look at the market. It has 2 clear components: internal range liquidity and external range liquidity. Internal range liquidity, also known as IRL, refers to fair value gaps within price. External range liquidity, on the other hand, refers to swing highs and swing lows on the chart. Now, the concept of internal range liquidity to external range liquidity states that when price is trading at an internal range liquidity, it has a high probability of moving toward the external range liquidity. And if price has just taken out an external range liquidity, then it will most likely start seeking an internal range liquidity next.